acquisition target. So I want to do two more slides. I think we're hitting an hour here, so it's pretty long, but bear with me for two more slides if you can make it. So are they an acquisition target? So this is actually not a good thing, I don't think. And unless it's a producer, and let's say you're up 300% or more, and you want to, because when a company gets taken out, you get a quick, 30, 40, 50% return, which is, not a terrible thing. Plus, like whoever took you over, your shares are going to roll into that company. So it might not be a terrible thing for a company in that situation. But if you're only up, say 100%, 200% or less, and you know that this company has a lot of upside potential, you don't want somebody to come in and steal that from you. You don't want to get taken out. But quite often, if you're in a situation where you're looking at a 3, 4, 5 plus bagger, then you're highly undervalued. So you become a target. Um, and this happens quite often with companies that are very cheap because there's no path to production yet. And the reason why there's no path to production is because the price of gold or silver is just not high enough. And so it's really, really cheap, and you're just a sitting duck kind of thing. And the only thing that can really prevent that is the insider ownership. And I mentioned this earlier. You want to be around 25% insider ownership or higher to prevent these takeover attempts. And whenever it seems like whenever there's low insider ownership and these companies are really cheap, seems like they always get approved. So the bad news is that the highly undervalued companies usually are acquired, unless because um, they just will be taken over. And so if you think you have found a wonderful investment, it will often be snatched away by a takeover. So that's why insider ownership is really important. You find these companies. Wait a minute, this company's valued at $10 an ounce, at $15 an ounce. Plus, they have all this um, upside potential. They have all this exploration potential. I'm gonna make an easy profit on this, and then it doesn't always turn out that way. Okay, spin out policy. Exploration companies, project generator, prospect generator is another word that they use. They often use spin out policies, and this really frustrates me because what happens is every time that they find a mine, they spin it out, and the only thing that you get is like 25% of your shareholders go into the spin out, and then you retain 100% of the original company, which never goes anywhere, just spins in place. In other words, your investment in that company, that 100% in that company, it doesn't go to the spin out company. You only get 25% or 20%. Happens all the time. So who's benefiting on these spin out policies? It's the management team. So when they do that spin out, they get more of the spin out. They don't get the 25%. They get, more than that. You get this little 25% of your shareholder value, and but that's free. Well, I want the whole, so I find that companies that have these spin out policies tend to be damaging to shareholders more than beneficial. It's rarely you see a 100% spin out of the quality project. It's even rare to see 50% spin out. So most of these exploration companies that do the spin out policies, these project generators, it doesn't always work out great, if you will. So that's something to be aware of. But I prefer if it's a one property exploration company, and then they find this big, great discovery. Well, they can't spin that out. There's nothing to spin out. That's the only property they have. So if it goes up, 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 then you're going to get that whole return. And then when they finally do get bought out, you're going to get your return. So I like the one. I'd prefer a one property exploration company versus 10, 20, 30 properties that's doing a spin out policy. Um, these have the effect of preventing company from growing. That's what I mean. Ideally, I load these policies and poison pills for growth.